Good morning and welcome to the Killik and Co market update. The latest GDP numbers for China have come in just below 5%, and although this is not a bad number compared to the rest of the world, we have become accustomed to China achieving rates of GDP growth well in excess of 5%, so this number did come as a disappointment. If you have a look at this chart here, you can see the rates of quarterly GDP growth for China going all the way back to the early 90s, and as you can see, it's consistently been above 5%, often above 10%, and therefore the latest reading of 4.9% was very much a disappointment. China has blamed the slowdown in GDP on higher energy prices. China is still particularly dependent on coal, and recently the Chinese government has been closing down coal mines and coal factories in order to reduce emissions within China. However, this clearly has led to a coal shortage, and that has led to a big spike in the coal price, as you can see by this chart here. The spike in the price has meant that many factories have not been able to afford coal, and that has led to many factory closures and also many electricity blackouts. And this supposedly is a big factor in the recent GDP slowdown within China. Recently, we have talked a lot about the increasing levels of regulation within China and about how that has really increased the risk of investing in the country, and this slowdown in GDP is yet another reason to keep a very close eye on what's happening within the country. The International Energy Agency has published its latest World Energy Outlook ahead of next month's climate change summit, and the report makes it very clear that significant further investments are required into clean energy if the world is to achieve net zero. Here's a chart that we've taken from the report. On the left-hand side, shown by the grey line, is the historical data showing how our emissions have changed over time. On the right-hand side, we have various different lines showing different trajectories for future emissions. The upper line shows the trajectory the world was on prior to the Paris Agreement, and now that the Paris Agreement has been made, the world has moved on to a lower trajectory, shown by the blue shaded area. Next month, we have the Glasgow Summit, and various pledges have been put forward. If these are adhered to, then the world will move on to an even lower trajectory, shown by the yellow area. But even if those pledges are adhered to, there will still be a significant gap in between where we are going and where we need to be, and that is shown by the green area on this chart. So much more investment is required into clean energy. Also within this report, there was a chart looking at the different market sizes of different energy types over the next few years if we are to reach net zero by 2050. So as you can see at the moment, the market for oil is very large in comparison to the market for clean tech. But if we move out to 2050 and look at the estimates, the market for oil should be relatively small in comparison to the market for clean tech. And within clean tech, this report expects that batteries and wind power will form significant proportions. So please do give us a call if you'd like to hear more about our thoughts on investing in clean energy. And finally, UK public borrowing came in below expectations in September, thanks to the end of the furlough scheme and also a rise in income tax receipts. However, UK government debt still stands at over £2.2 trillion, so Rishi Sunak has a very difficult job on his hands in bringing down that level of debt. Next Wednesday, we have the announcement of the UK's latest budget, and we'll be watching that very closely to see what plans he has in order to bring that level of debt down. Moving on to have a look at next week, it's looking very busy on the calendar, and we're expecting results from some of the biggest companies in the world: Microsoft, Amazon and Alphabet. That's it from us. Enjoy the weekend, and we'll see you next Friday.